What if one ordinary dollar, left alone long enough, could grow into something extraordinary without you day trading, guessing the next hot coin, or getting lucky? No tricks, just math. Compound interest is the idea that your money earns money, and then that new money earns more. It's a snowball that starts small and becomes unstoppable as it rolls. Learn to point it in the right direction, and time will do most of the work for you. Compound interest isn't complicated. If you invest $1,000 and it grows 10% this year, you end with $1,100. Next year, the 10% applies to the whole amount, not just the original 1,000. You earn 110. It's only 10 extra dollars at first, but repeat that process over many years and the curve stops looking linear and starts bending upward. That bend is where wealth hides. You can see this in a simple thought experiment. Imagine two lines on a chart. The first line is straight. That's simple interest, where you earn the same amount every year. The second line starts slow and then curves upward. That's compound interest. For a long time, the two lines don't look far apart. Then, seemingly all at once, the curved line pulls away. Most people never get to that part because they quit early. Compounding rewards patience more than brilliance. Look at Warren Buffett. He began investing as a kid and kept at it for decades. The surprising truth is that most of his net worth arrived late in life, not early. That's the signature of compounding: small, steady gains stacking until they appear to explode. If he had started 20 years later, the result would be dramatically smaller. Buffett isn't superhuman. He simply gave compounding the one thing it needs and can't manufacture later time. Here's a practical comparison. Investor begins at age 20, contributes $200 a month for 10 years, then stops and lets the money grow. Investor B waits until 30 to start and contributes $200 a month all the way to 60. Who ends wealthier at 60? Counterintuitively, A can beat B, even though B invested 3 times as much. Why A's dollars had a decade-long head start. In compounding, time often matters more than total contributions. A helpful shortcut is the rule of 72. Divide 72 by your annual return to estimate how many years it takes to double your money. At 6%, you double roughly every 12 years. At 9%, every 8 years. That means a single dollar invested in your 20s can double 4 or 5 times before retirement. You won't notice the first doubling. The fourth or fifth changes everything. Compounding has 2 levers: time and rate. Time is binary: you start now or you start later. Rate is your annual return. Chasing a slightly higher return with reckless baits can backfire. You can't stomach volatility. A steady 7% that you actually stick with for 30 years beats a swingy strategy that scares you out every other year. In compounding, a good plan you'll follow always beats a perfect plan you'll abandon. Contributions are the fuel. Automate a monthly deposit so you don't rely on motivation. Add a rule to increase it a little each year, 3 to 5%, or whenever you get a raise. Your lifestyle adapts quickly, but your compounding keeps the raise forever. Reinvest dividends so your money buys more of itself. Use broad, low-cost index funds to keep fees from quietly eating your returns. A 1% annual fee sounds small, but can erase a massive portion of your outcome over decades. Inflation is the silent opponent. If prices rise 3% a year, cash sitting idle loses purchasing power. Your goal isn't just to grow numbers, it's to grow what your money can buy. That is why investors look for assets that historically outpace inflation over long periods: diversified stock funds, ownership in productive businesses, or real estate. Focus on real return, the return after inflation, not just the headline number. Compounding can also work against you. Credit card debt at 20% interest is compounding in reverse. If you revolve a balance and only pay the minimum, interest gets added to the principal, and next month you're charged interest on a bigger number. The snowball that could have worked for you becomes an avalanche, burying you. Before dreaming about doubling your money in the market, stop your money from having itself under debt. Eliminating a high-interest balance is often the best investment you can make because its return is guaranteed. Behavior is the make or break factor. Many investors sabotage compounding by switching strategies constantly, trying to time the market or panic selling during downturns. Miss just a handful of the market's best days, and years of gains can disappear. Compounding likes boredom, it rewards consistency, not drama. The winners aren't always the cleverest. They're the ones who set up automatic contributions, stay diversified, ignore noise, and let time keep score. Use the tools designed to help you. In the United States, a 401k often includes an employer match-free money that accelerates compounding. Roth and traditional IRAs offer tax advantages that keep more of your returns invested. In the UK, ISAs allow tax-free growth up to annual limits. Lower taxes today mean more fuel compounding tomorrow. Pick the right account for your situation and let the rules be a tailwind. Start small if you're nervous. Fund the account with an amount you won't miss and watch it for a year. The goal isn't to win the market this month. It's to build a habit you won't break. Increase the contribution when you can. Build a modest emergency buffer so you aren't forced to sell investments during a downturn. Expect scary headlines. Expect rough patches. Stay the course anyway. Compounding is patient forestry. Plant, water, and wait. From the ground, growth looks slow. From the sky, a forest appears. Give your money time, give it consistency, and protect it from fees, taxes, and high-interest debt. Do that, and the math that quietly built fortunes for decades can start working for you. This is education, not personal advice, but the principle is universal. Start now, keep going, and let time do what time does best.